Welcome back. Today we're looking at AllianceBernstein's 2026 strategic investment outlook and asking a simple question. Now that we're in 2026, how well did their call line up with actual market conditions? The short answer, partly right, but not perfectly right. I'd score it roughly 65% on, 35% off so far. AllianceBernstein's core message was not wildly bullish. They said investors should stay overweight equities, especially US equities. But they also warned that high valuations, market concentration, and AI-driven enthusiasm could create real volatility risk. That part looks pretty accurate. US equities have remained strong in 2026, and AI continues to be the dominant market story. Mega-cap technology companies, AI infrastructure, and names tied to the AI build-out are still carrying a lot of the earnings. So AB was right to say that AI would be both the biggest opportunity and one of the biggest risks. Their warning about concentration also holds up. The market is still heavily dependent on a relatively small group of large companies. That does not mean the market has to crash, but it does mean the market is vulnerable to yields and inflation surprises. Where AB looks especially right is on long-duration bonds. They were cautious for very specific reasons. They were cautious on long-term nominal bonds because of debt sustainability, inflation risk, and changing portfolio roles. In 2026, that has been a good warning. Long yields have remained under pressure, creating problems for duration investors. They were also right to remain constructive on gold and non-fiat assets as hedges against debt and uncertainty. AB's view was not that the dollar would collapse, but that investors would look for hedges. That has aged well. Now, where were they off? The biggest miss is inflation and central bank policy. AB expected inflation to trend down and give central banks room to cut rates, but 2026 has been stickier. Inflation has not cooled as cleanly as expected, and rate cut expectations have been pushed out significantly. The Fed has had less flexibility than AB's outlook implied, which makes the soft landing setup much harder. Their earnings view may also have been too cautious. AB expected low growth, but corporate earnings stayed strong. So the irony is this: AB may have been too optimistic on inflation, but too cautious on earnings. On private markets, their logic still makes sense. They were cautious on equity while favoring private debt. Floating rate income still works better in a higher rate environment. So far, that call looks reasonable. Here's the takeaway. AB got the market regime mostly right: US leadership, AI dominance, and equity resilience. But they were too clean on the macro path. Inflation has been stickier and the bond market more threatening. So was the 2026 outlook on or off? I'd say directionally on, tactically mixed. In 2026, that difference matters.